Hello everyone, welcome to the Stock Trading Tutor channel. If you would like to create a free Demat account, click the link in the description and fill out your details. Now let's look at cash flow statements which are required for fundamental analysis. When it comes to fundamental analysis, there are three major financial statements that every investor studies in order to get a better picture of a company. These are profit and loss statement, balance sheet, and cash flow statement. Let's look at the cash flow statement. A cash flow statement is a financial document that reports the actual inflows and outflows of cash in a business during a certain period. A cash flow statement is an integral document of financial reporting since it tells the reader how much cash is being generated by the company in a specific time period. When cash inflows are greater than the cash outflows, it is an indicator of good financial health. This is known as a positive cash flow. It is important to note that this statement does not include any income in the form of future receivables or any expenses that the company owes. Here's how a cash flow statement looks like. As you can see from this sample, we have cash flow from operating activities, cash flow from investing activities, and cash flow from finance activities, and then the totaling of the cash balance at that specific time period. So now, as we saw in the sample, the major components of the cash flow statement are cash flows from operating activities, investing activities, and financing activities. So now we'll be seeing the cash flow from operating activities. Now, operating activities include activities that generate revenue for the company. This includes core operations such as buying raw materials, building inventory, and production of goods and sale of products. The cash flows from operating activities offer great insights into a company's liquidity. As an investor, you can understand how a company generates its cash through its core operations. If a company can generate higher amount of cash from sales compared to the cash required for expenses, it is a very good sign. This means that the company does not have to depend too much on borrowing from external sources. It can reinvest the surplus cash back into the operations. Now let's look at cash flow from the investing activities. Investing activities typically represent the purchase and sale of assets or investments by the company that will offer returns in the future. Cash outflows include the purchase of fixed assets and financial assets such as bonds and shares of other companies. Cash inflows come from the sale of existing assets and investment securities. Capital expenditure or CapEx is an important measure found in this section of a cash flow statement. It is used widely by investors in the valuation of stocks. For instance, if the company uses most of its CapEx for maintenance or repairs of existing assets, it generally has lower valuation compared to a company that uses its CapEx for purposes of growth and productivity. Now let's look at cash flow from financing activities. This segment in the cash flow statement focuses on the cash inflows and outflows from a company as a result of raising and repaying capital. Cash inflows are raising fresh debt, raising fresh equity, repurchase of shares, and so on. Now, the cash outflows here are repaying debt, paying dividends to shareholders, paying interest to creditors, etc. This section is a great interest to prospective investors because it offers information about the company's dependence on debt for its cash needs. Greater financing from debt can impact the company's profitability in the long run. Now let's look at free cash flow. Another section known as free cash flow is also considered to be important in the analysis of cash flow statements. Free cash flow is calculated by operating cash flow minus the capital expenditure. This value gives you an idea of how much cash the company generates after spending for capital expenditure activities such as maintenance and expansion of its assets. Free cash flow is a good indicator of the company's ability to generate profits. A positive value means that the company has good profitability, but at the same time, it is important to note that negative value does not have to be all bad. It could simply indicate that the company has made large investments for the future. This could result in high potential returns for the company in the long run. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you would like to create a free Demat account, click the link in the description and fill out your details.